Last week we started with the financial statement, and then we said according to International Accounting Standard 1, okay, spell out the financial statement, which include the following: statement of comprehensive income, that is the P&L account, and then it also comprised of the statement of financial position, that's the balance sheet. It also comprised of the statement of cash flow, statement of changes in equity, the note to the financial statement. And then we dealt with the balance sheet, where we said the balance sheet, okay, it represents the asset owned by the company and the claims against the asset. And then we said according to the accounting equation, asset is equal to liabilities plus owner's equity, whereby we talk about the current asset, the non-current asset. We talk about the current liability, the non-current liability, and the owner's equity we dealt with. And then we look at the format of the balance sheet. Then we came to the income statement. We said that if you want to find out whether the company is making profit or loss, we look for the income statement. Okay. So we said that the net income is equal to revenue minus expenses. And then we look at the items or the verb that goes into the income statement. Okay. We look at it. We say revenue, cost of goods sold. We talk about the operating expenses, the interest cost, and the tax expenses. Then the gross profit, the operating income, the earnings before interest and taxes, the earnings before taxes, then your net income. And we look at the format of the income statement. These are some of the examples of the income statement. Okay, so let's also look at the statement of changes in equity. Statement of changes in equity. We all know the equity, right? Okay. Statement of changes in equity. So this summarizes how net assets are financed. How net assets are financed. We know net assets. Net assets, we are talking about when you compute your current asset and your non-current asset. Okay? Okay. When you put them together, you have your net asset. Okay. It shows the composition of shareholders' claims on the asset. And the components are, we have the stated capital. Stated capital. This represents the paid up shares in the firm. So the statement of change in equity will indicate the stated capital. And what does it mean by the stated capital? Okay, the stated capital represents the paid up shares in the firm. Okay, the shares that have been paid. Okay, companies may issue ordinary shares or preferred shares to shareholders to raise equity. The portion of the authorized share capital that is issued and paid up represents the stated capital. The stated capital cannot be appropriated, and so they remain fixed until there is a new issue or a recapitalization. In Ghana, authorized shares do not have par value, the nominal value. There is therefore no concept of share premium, but you should understand how these arise. Then we also have the statement of change in equity also shows the capital surplus. So to indicate the stated capital, it also indicate the capital surplus. So what do you mean by capital surplus? That also refers to as revaluation reserves. They arise when assets are revalued and represent the excess of the current asset values. That is revaluation amount over the stated cost. Then it also indicate the income surplus. Income surplus. You find the income surplus in the statement of changes in equity. What is the income surplus? This is an income reserve fund. They arise when firms retain part of their net profit to reinvest in the business. This is distributable. Then it also indicates other reserves. Some firms may have other reserves for specific purposes. Most times, these are statutory reserves required by industry regulators. Then let's come to the statement of cash flow. So the statement of cash flow indicates the movement of cash, how cash is moving into the business, and how cash move out of the business. So you want to find out about all payment made and all cash received.
Hello, sir.
Yes.
I raised my hand there.
Okay, your name, please.
My name is Sam. Please, let's go to the previous slides.
Okay.
Okay, so you stated that this is distributable. What does it mean? Income surplus. This is distributable. What does it mean?
Okay, income surplus. This is distributable. Okay, somebody's asking when we say it's distributable, what does it mean, please? Remember, I told you when you are asking a question, you're asking the entire class, right? When I'm asking a question, I'm asking the entire class. So he want to understand that the income surplus, I said it's distributable. What does it mean that I indicated that, or in the slide say distributable? Remember, distributable is an English word. Can somebody help him, please?
Sir, this is Bismarck.
All right, Bismarck, please go ahead.
Sir, it means it can be shared among shareholders when the need arises.
Okay. Okay. Any other opinion or more explanation to that? He said it can be shared among the shareholders. Okay, when the need arises. That income surplus.
Hello, sir.
Yes.
Okay. It also means that excess amount can be allocated or used for specific purposes rather than being locked up in, let's say, the company coffers.
Okay. So please come again. The excess amount can be used for or can be allocated for
The other specific purposes rather than being locked up.
Okay. Okay. I believe you have gotten the answer, right? Bismarck.
The same that asked the question. I'm not all that convinced with the answers provided anyway, but then I think we can proceed.
No. Bismarck, you said you are not convinced with the answer. So what answers were you expecting?
Okay, so my understanding is that the income surplus is reserved for, as stated in the slides, to be reinvested into the business. So, for example, if a company makes a profit of, let's say, 100,000, they decided that, okay, we are going to reserve 80% of that to be reinvested into the business. So that the 80% is the income surplus we're talking about here. And the 20% is distributed to the shareholders, maybe in the form of dividend. Okay, so the income surplus reinvested into the business increases what? The value of the company, whereby increases the share price of the company. So where it is stated in the slide that it is distributed, that is where I'm a bit confused with that particular statement.
Okay, so your explanation to their explanation, is there any difference? Is it not the same? Bismarck.
I think they are all the same.
Yeah. So that is why I asked you, are you okay? Are you convinced? Okay. So they are all the same. Okay. So Bismarck, they are all the same to your explanation. All right. Thank you. Okay. So the statement of cash flow, as I was saying, is a statement or is a financial statement that indicates the movement of cash into the business and out of the business. So the income statement and the statement of financial position do not give a complete picture of the firm's operations for a number of reasons. Okay, so it doesn't give reason for purchases and sales, but it only give you the are often made on credit. Some services may be enjoyed before they are paid for, and some services may be paid for in advance. Okay, it will not give you the reasons, but only indicate the movement, or it only indicate the payment, okay, made, and then the cash received. That's all. To not you not see that okay, receive this amount of money because of this reason. No, no, no. There are a number of items in the income statement that do not affect the cash position. This includes depreciation, bad debt, and provision for bad debt. So these items do not affect the cash position. Some transactions, such as issue of shares and purchase of fixed assets, are not recorded in the profit and loss account. Okay, take note of that. A declaration of profit, therefore, does not suggest that the firm has no cash flow problems. The cash flow statement reveals the cash position of the firm, which is important to management, lenders, investors, analysts, and other stakeholders. So the statement of cash flows analysis changes in cash and cash equivalent during a period. Cash and cash equivalent comprise cash on hand and demand deposit, together with short-term, highly liquid investment that are readily convertible to a known amount of cash and that are subject to an insignificant risk of changes in value. Guidance notes indicate that an investment normally meets the definition of cash equivalent. So we know cash and cash equivalent, right? So we are talking about cash and cash equivalent compared to cash on hand. So cash you have in your pocket, okay, or demand deposit, okay, is what we mean by the cash and cash equivalent. Okay. Okay, so presentation of statement of cash flows. So cash flows are classified and presented into operating activities. So we classified and represent statement of cash flows into one, operating activities, investing activities, and financing activities. So these are the three categories. Okay, you find under the cash flow statement operating activities, investing activities, and financing activities. Okay, now let's take them one by one. Operating activities are the main revenue producing activities of the entity that are not investing or financing activities. So operating cash flows include cash received from customers and cash paid to suppliers and employees. This comes under operating activities. So let's take, for example, GCTU. So in the cash flow statement, under the operating activities, we will have fees collected, right? Okay. Investing activities are the acquisition and disposal of long-term assets and other investments that are not considered to be cash equivalent. So if the business is investing, is under, let me say, developmental project, okay? So all those activities falls under the investing activities, right? Like building of hostels and other things, because at the end of building a hostel for the university will generate revenue from the hostel because students will be charged with hostel fees, and every semester or every academic year they will pay hostel fees. right? So all the cash involved under the investment activities comes under the wholesale project will fall under the investing activities. They also had the financing activities, actually that alter the equity capital and borrowing structure of the entity. Okay. They had the interest and the dividend received. They had the cash flow arising from taxes on income. So cash flow arising from taxes on income are normally classified as operating unless they can, just 1 minute. Unless they can be specifically identified with financing or investing activities. Okay. All right. No, you pay tax, right? You pay the income tax. So it should count under the operating activities. Because, okay, so these are the various activities that come under the various classifications of cash flow statements. So under the operating, so like car sales, refunding car sales, getting paid by debtors, buying stock for cash, repaying creditors, getting refunds for stock returned, repaying creditors, giving out loans or lending to others, getting interest on deposit, paying staff wages, paying bills or other expenses, paying tax, getting a tax refund. So all these activities falls under the operating activities. Then under the investment activities, buying land or buildings and paying cash, buying other assets and paying cash, getting refunds for assets returned, buying investment and paying cash, receiving dividends. All this comes under investing activities. Then under the financial activity, you have new shares issue or right issue, taking out loans, debentures, paying dividends, paying interest on loans, comes under financing activities. So this is an example of the cash flow statement, a popular format. So we had operating activities, that is operating profit, depreciation charge, increase in stock, increase in debtors, increase in creditors, cash flow from operating activity. Then have the financing activity, dividends paid, interest paid, tax paid, right? Then come to the investment activity, you have non-current asset purchased, debenture, stock issue, they are the net cash flow. It's an example. So, okay. So this is a question. I just put it, just try it when you are free. Okay. All right. The direct method. But in your, I'm only teaching you this, but I'm not going to ask you questions in your assignment to do this. In your assignment, you'll be given an assignment to analyze the financial performance of a company, and then you'll be given information from the website. You go there, you download it, and then you analyze the business performance. Okay, you just use the balance sheet and then the income statement of the company. You just download the income statement, or you can use the balance sheet. Then you compare year to year. Okay, when you go to the analyze financial statement. Okay, but you're not going to prepare the income statement. You're not going to prepare the financial statement. Please, nobody's going to ask you questions to prepare the financial statement. Okay, all right. So you need to know what goes into it. Now let's talk about some important accounting concepts and principles. These are basic concepts and principles, right? We have what's called the entity principle. So entity principle say that the business is considered as being separate from its owners. So business is expected to be separated from personal affairs of the owners. The assets and liabilities the business acquires should not be mixed with the assets and liabilities of owners. So for example, if Mr. A is the owner of company ABC, and the company ABC has 10 cars, and Mr. A has 2 cars. You can't say that company ABC has 12 cars. No. The asset and the liability of the company is different from the owners. So we see the entity concepts state that the business is a separate body on its own, and owners are also a separate body on its own. So when an employee is suing the company, any member of the management can go to court to represent the company. But when an employee sues the owner, no member of the company or no manager of the company can go to court to represent the company. No. So the business, the activities of the owners are different from the activities of the business. That is why it is always wrong for owners to tell maybe the MD, the finance director, please, my son is coming there, my wife is coming there, issue a check of this. No. They can use their personal activities, can't mess with the business activity. No, it's completely wrong. If they do that, they will collapse the business. So the business activity should just run. And then that is why you see, if you could remember, 2019, some banks were collapsed due to what? Bad corporate governance. Because of this, the shareholders were going for loan and they were not paying. It should be so. They think the business is for them. They are the owners of the business, so they can do whatever they want to do to the business. And now the business is no more where to be found. So as an accountant, as a manager, you should understand the entity principle that the business is a separate body from the owners. Okay. The next concept is a going concern. Talk about going concern. Now, going concern concept explains that assume that the business entity will continue to exist for the foreseeable future. This assumption is important because if the future of the entity is found to be uncertain, then a different set of accounting rules will have to be applied. So the going concern say that once the business exists, the business will continue to do business. Example, one GCTU exists. What are the business GCTU is doing? GCTU will continue to admit students, to recruit staff, to teach students, to graduate students. Once MTN exists, MTN will continue to sell data to customers. MTN will also continue to provide mobile, Momo service to its customers. That's the going concern, unless it is no more. That's the going concern. So going concern talk about once the business exists, once the business is alive, the business will continue to do business. The accrual is also accounting concept or principles.
So, sir.
Yes.
Okay, this is Sam. My name is Sam.
Mm-hmm.
In financial statements, when they are published, we see this going concern clearly stated in the financial statement. However, my question is, when the auditors are expressing their opinion, are the going concern, is it for the next 1 year assurance they are giving to the people or the users of the financial statement, or it's a forever assurance they are giving?
Please come with your question. I guess everybody will understand you, so they will to understand you.
My question is, this assurance of going concern,
okay,
is it for the next 1 year, or is forever assurance they are giving the users of the financial statement?
Okay. He's asking a question to the class. Anyone can answer him, please.
Okay, sir, to my understanding.
To exist.
Yeah, who is speaking? Yeah, who is speaking, please?
Very.
Okay.
Mm-hmm. Yeah. So the assumption is that the business will continue to operate for a foreseeable future. So it's not just for 1 year. I don't know if I understood him, but that is what I understand about business, a going concern.
Okay, other one was speaking, the other person was speaking. Who was that, please? Another person was talking. Who was that, please? You can go ahead, please.
Okay, sir. So based on the explanation given by my colleague, so how do we marry this concept with, let's say, a capital bank? Before the bank collapsed, maybe the auditors might have expressed this particular opinion that the business will continue to operate in the foreseeable future. Then we wake up the next morning, the Bank of Ghana says, hey, you cannot operate again. So how do you marry the two? Is it the next year or forever?
Yes, the floor is open. Mm-hmm.
Okay, sir. To my
this
understanding, that's Kingsford.
Yeah, Kingsford. Okay.
Yeah, according to the IASA standard one, we talked about going concern concept when you are preparing your financial statement. Because I know that anytime the auditors are preparing, they are giving their concern of the video. Use what IASA one because the business is going to continue to operation for unforeseeable future dates. So any financial statement or any audited view that they will provide, meaning that the business will continue operating in the for future purpose. That's the reason they prepared the going concern consider assumption that they give on that. Thank you.
Thank you. Any other, please? Any other, please?
Okay, hello, sir.
Yeah, your name, please.
This is Gilbert.
Okay, Gilbert.
Okay, my understanding about the foreseeable future means that a period of time that can be reasonably predicted or anticipated based on the current knowledge or trends of the business.
Okay.
So, and it is presumed that the business is going to span for a particular period of time, but it cannot be predicted the exact date or time. Enough for people to make reliable assumptions about what might happen in, let's say, the next period or months or years.
Okay. Any other?
I also wanted, yeah, this is Emmanuel.
Okay.
Yeah, I wanted to say that, I mean, the going concern is an assumption that the business will continue to exist. But whenever the auditors do their report, I think in their report, they will always raise a concern when something is going wrong. But since the business is a going concern, they presume or assume that as the business is going, that concern will be corrected. So I just want to ask the question that I just want to answer the question that my colleague asked. So business always be a concern since it's a going concern, it's in existence. There's an assumption that it will exist forever. But when there's any kind of another concern which will bring to the end of the business, auditors always raise that concern. But it's assumed that as the business is still in existence, that concern will be corrected and the business will continue to exist. Thank you.
Thank you. Any other, please?
Hello, sir.
I want to add that.
Hello, sir.
Your name, please.
Okay, this is Richard.
Hello, sir.
Richard. Okay, let Richard finish, then you come in, please. Okay.
With what Sam asked, I believe the auditors say that based on their current findings, I mean, to the next audit, everything should be fine. That is what I think. So based on what they found for this year, to the next audits they do, everything should be fine.
Okay.
Their prediction.
Yeah. Yes, please, now you can come in. Hello, somebody wanted to talk and I said, let this person finish before he comes. You can come in.
So this is Bismarck.
Hello, sir.
Yes. Your name? Please, your name. Okay.
Sir, please, my name is Anthony. Anthony Dia.
Anthony, please go ahead.
Sir, please, my name is Anthony.
Okay, Anthony, you are listening.
The going concern. Normally, businesses are owned by shareholders, and the rule says, or the law says, that the business should distance himself from the shareholders. So going concern it means that whether they are owners of the company, the business will still operate. So it's beyond the shareholders' so many activities. So in summary, it means that whether they are shareholders or not, the business should go on. That is the meaning of the going concern.
Okay. Okay. Somebody was about to speak. Please, can go ahead.
No.
Yes, your name. Please go ahead. Your name first. Okay, so Bismarck, you asked your question. Is it Bismarck who had the question?
It is Sam that asked the question. My name is Sam. Yeah.
Sam, okay, Sam. So have your question been answered?
Yeah, so one of my colleagues mentioned that it has a time limit, and the literature we have read on this going concern, mostly they are specifying 12 months. So the next audit, so the foreseeable future has a time limit of just 1 year. So that is the other literature on this particular going concern. Thank you.
All right.
So, Doc.
Yes, please.
I think the 12 month, which is 1 year, is just the minimum assessment period used in accounting standards. So normally, the going concern actually means the business is expected to continue operating indefinitely in the foreseeable future, not just for 1 year.
Okay.
Exactly.
Okay. So you got it. Is it Simon? What's the name?
Okay, sir. I'm okay. Yeah.
The one who asked the question.
Yes, please. I'm okay.
Okay. All right. Okay. Thank you. Let's continue. Accrual. So this is very important principle for income and expense recognition. Under cash accounting, transactions are recognized when cash is either received or paid. To avoid this problem, accounting recognizes transactions either when cash is received or paid, or when it is reasonable certain that cash will be received or paid. Okay, so we know that once the accrual talk about we will pay in the future or receive the cash in the future. Okay, that's all accruals. That deferrals. Okay, so we understand deferrals. Okay, then you also have the matching concept. The matching concept principle, which is closely related to the accrual principle, state that operating performance can be measured only if related revenue and expense are accounted for during the same time period. I'm going over again. The matching principle, which is closely related to the accrual principle, state that operating performance can be measured only if related revenue and expense are accounted for during the same time period. What does it mean, please? The matching concept. What does it mean, please?
Okay, sir. So what?
Okay.
Yes, you mention your name, then you continue, please.
Okay, so my name is Sam. So what it means, the revenue that you have earned in a particular period should be, and also the expenditure that you have incurred within that period to generate the revenue, they should be captured within that period. It shouldn't be, let's say, the revenue sum fall in next year, then you account it within this year. No, So the revenue against the expenditure. So if you have spent 20 cedis to generate a revenue of 100 cedis, the two should be recorded within a particular period in which they have occurred.
All right. Any other explanation? Okay. Okay. Interpretation of financial statement. Now that we have understood the thing that goes into the, please let us try to mute our mic, okay? So that we will not disturb the class. Once that we have understood the variables or the information that should be considered or included in the financial statement, we also need to understand how we can analyze this statement. Okay. So this brings us to the interpretation of financial statement. Interpretation of financial statement. Now, when we are interpreting financial statement, who are we interpreting these financial statements to? That's the question. When we prepare the financial statement and we interpret, who are we doing this to? Okay. So we call them users of financial account or users of financial information. And they are, we have the customers. So the customers want to understand prices and compare with its competitors. So for example, customer want to buy, or when a customer want to buy from your shop, the first thing the customer look at is the quality and the price. So if the quality is low and the price is low, but the same product is sold in other shop, but the price is high, the quality is low. But in the other shop, if the quality is high and the price is high, they compare. So they need this information. Employees also need information about the financial statement. Okay. Now let's take them one by one. Customers. What kind of information do you think customers need? Okay. We will come to that. So you have the customers, the employees, the government, and their agencies, right? So the government and their agencies, you know them. Okay. The revenue collectors, right? You have the investors, you have the lender, you have the public suppliers, and other creditors. Let's take them one by one. So accounts are prepared for the benefit of users who are interested for a variety of reasons. Let's start with investors. Investors. Who's an investor? Who is an investor? Yes. Who's an investor? Yes, who's
Hello,
an
Doc.
investor? Yes, please.
Yeah, an investor is a person who puts his resources into a business.
Okay.
Yes.
So my question is your MSc, your MBA finance, your MSc finance program, okay? Your MSc finance program, is it an investment?
Yeah,
Yeah, it's an
it's
investment.
Why?
an
What's
investment.
making it? Why? What's making investment?
Because we are expecting a return for the whole program.
Okay. Okay. Now let's go back to investors. Okay. So investors need information about the profitability of the business. So whether the business is making profits or not. The dividend yield, the price earning ratio in order to assess the quality and the price of shares of a company. So before an investor can invest into the business, they look at these things. That information important. And you find the profitability, the profits from the income statement. And how much is paid for dividend to you find them in the financial statement. Right? So this will convince investors that, oh, okay, this business, when I invest, I'm going to receive this. Oh, then I have to invest. So that is why they need information about the financial statement. And you know the financial statement should be published to the public. It should be published to the public domain. It's not anything private. Okay. Lenders. Who is a lender? Who is a lender, please?
Sir, do they also need to know? Hello, sir.
Yes. Who is talking, please?
Interested. I think they are also interested in the going concern
Your name?
part of the business, because
Your
I
name?
expect that Vero.
Okay, Vero.
Vero.
Oh,
I
yeah,
think
it's
I
part of it.
recorded.
That's fine. Yeah, that the going concern will come in, is fall within the profitability. Now, it means
Okay.
that, yeah, it's fall within the profitability. If the business is making more profit, it means the business can survive. But if the business is not making profit, you look at the financial statement for the past 5 years, 3 years, and they're not making good profit. Do you want to waste your money or resources into this kind of investment? Oh, you get it? All right. Okay. Lenders. Who is a lender, please? Who is a lender?
The one who give money to the business, or who put money for interest.
Okay. So this is a layman. Let's go to.
Okay, when you talk about the lenders, they are the
Yes.
borrowers to the entities. They are the people who borrowed money to the entity for them to run their businesses, or the shareholders.
Okay. Any other explanation, please?
Look, I want to ask a question concerning what my colleague just said. So, is a shareholder a lender or an investor?
So we come to that. Let's understand the concept of lenders, and then we come to, is a shareholder a lender or investor? Okay. Yes. So
So a lender is an individual or institution or organization that provide money or credit to someone with the expectation of being repaid, usually with an interest.
yeah, please, you can come again. Okay. Charlotte.
I'm saying it's an individual or an institution or an organization that provides money or credit to someone, that's the borrower, with expectation of being paid with an interest.
Okay. Okay. Do you have any other explanation to lenders?
Okay,
yes, please.
A lender is an individual or business entity that provides a financial cushion to a business or individual to enable them remain afloat.
Okay. Okay, so all what you guys have said, you are all right. So what I want to add to is that a lender is either an individual or an organization that has surplus of funds. Okay, for that matter, lends money, okay, to the financial institutions or the financial intermediaries, to borrowers. Okay, that becomes a lender. So once you have surplus of funds, what do? You go to the financial intermediaries, and then you lend your money to them, and they in turn lend to borrowers. The borrowers also can be individual organizations. Okay. Now let's come back to the question one of us asked. Okay, shareholders, are they investors or lenders? Now the floor is open.
Sir, please the question again.
Shareholders are invested.
Somebody asked a question that
Sir, this is
shareholders are they investors or lenders? So the floor is open. Vero, please go ahead.
Yeah, I said I think shareholders are invested. Unlike lenders, you see, when you said about lenders, when we have the intermediaries, some businesses may even get loans and other things from people they don't even know. Because when you have financial intermediaries, they take money from people who have surplus, and then they invest. The business owner goes for it. So the person even lending the money to you doesn't even know the business they are even taking your money to. But with the shareholders, they have interest in the businesses. So shareholders are investors. They are not lenders.
Okay. Any other or additional or a
Okay, so this is
counter?
I think shareholders are investors because when they buy shares in the company, they don't expect to be paid profits, but rather dividends. Like interest rather, but rather dividends at the end of the accounting period. Unlike lenders who expect interest within a period of time.
Okay.
okay. So this is Bismarck.
Okay, Bismarck. Mhm.
Yeah, when we talk of shareholders, we have two types of shareholders. We have the preference shareholders who are naturally investors, whether or not the business make profit or not, they have to be paid. On the other hand, shareholders are part owners of the business. They own part of the business. So whether the business make profit or not, they suffer. Hello, sir.
Please, are you done? Hello, the one who just spoke. Please, are you done?
Yes, sir.
Okay, so the question we are discussing here is not preference shareholders. We're talking about ordinary shareholders or equity shareholders. Okay, that's the question people were asking.
Hello, sir.
Yes, please. Okay.
Please, my name is Anthony.
Anthony, please go ahead.
What I would say is that they are all investors, but the only difference is that one receive interest and one receive dividend. The people that receive dividends, they are the people that say they are the owners per se, because when it comes to the document wise, they have fair knowledge about it. So basically, they are all one, but the only distance is the interest and the dividend. Thank you.
Okay.
This is Richard.
Richard, okay.
Yeah, I want to say that investors or the how do you even call them? Shareholders. They are investors because if the business makes profits, they get the dividend. And how do you call these people? The lenders. Whether or not the business makes profit, you have to pay them plus the interest. They don't really care about whether your business is doing well, even though they checked before giving you the money. They understand that once they've given you the money and you've agreed on paying a certain percentage, whether you do well or not, you should be able to pay them. But the shareholders, it doesn't work that way. It's what the business makes, that's what they get.
Okay. I want to ask a question. Have you ever heard about somebody who have invested into a business and the initial discussion was that maybe the person will be getting, let me say, 30% return after 5 years. And then within the year, the value falls. So the company was not able to pay for the full amount as discussed. So they have to slash down. Have you ever heard about this before?
Yes, sir.
Yeah, something like that.
Yes, sir.
Yes.
Yes,
Good.
it happens.
Good.
Haircut.
I don't want to mention. I don't want to give a typical example.
But I
So-
said that's a typical example, haircuts.
Yeah. So you see, so the investors are different from lenders. For lenders, whether the business or whether the value has come down or not, you have to pay the lender because the person lends the money, and that is an agreement. The person can take you to court, all right. But this one, there's explanation to that. That this is the portfolio we invested, and the entire the value for, so that is why we are unable to pay. Okay, it happens. All right. So coming back to the question, so now are we convinced that shareholders are not lenders, but they are investors, right?
Yes, please.
Yes. Yes.
Okay. Thank you very much. Okay. Now, so lenders need information about profitability and solvency, but investors don't need information about solvency. Yes.
So this is Sandra.
Sandra, okay.
Yeah, so can we say that lenders in some way are also investors?
Oh yeah, but they are not investors.
Okay.
They are not rare investors, right? If you they are somewhere invested, even though they are lending money through the financial intermediary, because at the end they are getting return back. You see, the main difference, that's why I want to come there. You see, they need information about the profitability, like the investors, all right. But they also need information about solvency of the business. What is solvency? What is solvency, please?
Whether the business is financially sound.
Exactly. Exactly. So for example, you know your friend is not working and he calls you, oh Charlie, I need about 10,000 or 10K to sort out things. Give me within 1 week, I'll pay. You know that your friend is not working. You know that your friend is not in the capacity to pay back the money and give the money to the person, right? So lenders look at what solvency, ability to pay back. These are the information they need about the company. And the solvency, you get the information from the financial statement. Oh, they pay. Oh, yes. For this company, oh, they pay quickly, they pay on time on this. Okay. So these are the main difference. Okay. The management also need information about the financial statement for planning, to plan for future, for policy making. So in case the company is, for example, the company is making or incurring more cost, so they have to what? Reduce cost. For example, if in every office or unit we have printers, we have the A4 papers, we can print anyhow. Management can come up with a policy that okay, for every month, every unit is supposed to print maybe one rim A4 sheet, one rim of A4 sheet. If you finish it or if you exhaust your limit, you have to incur the cost for the additional cost. So, or they may collect every office printer and use centralized printer. You print. So people will not be printing their personal stuff and other things, right? To minimize cost. And also for evaluation, that is the business doing well, to evaluate the performance of the business. So these are the information management needs. Supplier, who's a supplier? Who is a supplier? Who is a supplier?
When you talk about supplier, they are the individuals or an entity that provide goods and services to the company.
Okay. Example.
Maybe
Creditors.
Creditors.
Don't confuse her with trade creditors to suppliers. Okay. So you gave a very good explanation to suppliers. That is, they supply goods and services, right? To either the individual or the organization. Okay, who is a trade creditor? Who's a trade creditor? Yes.
Trade creditors, they are the individuals who supply goods to entity on credits.
On credit. Once you bring on credit, the person becomes a trade creditor. On credit. For example, you see our Makola ladies with big shops. You see the pharmaceutical shops. They buy those drugs on credit. You see our hospitals. So the suppliers supply this medicine or drugs to them on credit. Maybe 2-3 months, and they go for the money. So they become what? Trade creditors. All right? Trade creditors. But when they go there and pay them on cash, the supplier can receive cash, right? So the supply is general. So the trade creditors fall within the suppliers. Okay. So suppliers and trade creditors need information about the liquidity of business in order to assess the ability to repay the amount owed to them. Where liquidity means what? Liquidity of business means what? What do you mean? How do you understand by the word liquidity?
Cash, more cash.
Cash. Exactly. Okay. Then the other users, okay, we have the tax inspectors. They need to be able to calculate the tax payable. Very, very important. Then the government also need information about various business for statistics and formulation of economic plan. So the government need to know, for example, if they need to know that this business is doing well, it means this business can survive for the next 2 years from the financial statement. You know, at the end of every year, every registered company file returns to the registrar general. So that's where they get the information. The customers also are interested in long-term stability.
Sir,
Yes.
I think with government, it's not sometimes just about tax. Sometimes even for support, because some companies get financial support. I think from with the support of government, because if they see this business, yes, and it can expand, the government come in to support them. Employment purposes and other things.
Exactly. Oh yeah.
Not just for tax.
Yeah, not only just for it's true. You see, even formulation of economic plan, right? They all fall under this. Okay, and it's broad. I don't want to go there much because we don't have time. Okay, customers are also interested in long-term stability of the business and continuance of the supply of particular product. So let's say, for example, you are out before you are a student. Before you came or you were admitted as a student, you were what, applicant, right? So you did your background check. Is this university a public university? Is this university, are these programs accredited? You understand it? So you find about, so because you want to be sure before you make a decision. Because at the end of the program, if you finish or if you enter, you go there, you pay your fees, and you're unable to maybe use the certificate for what you want to use it for. It's a waste of money. So you show the product to the customer, and the customer want to know that at any point in time when I come to this company, I'll still get the same product because this product have helped or have solved my problem for me. So that's what customers are interested. Okay, so will the business continue to survive or collapse? So if the business will be there today and tomorrow the business will not be there again, then why should I go and buy this particular product from the company? No. So they need to know that this business can continue to supply this particular product in the long run. It's very, very important. And they will get to know this one when you display or you publish your financial statement that, the business is doing well. It means the business can survive. It means, this business can survive for a longer time. Employees are also interested in the stability of the business to provide employment, fringe benefit, and promotion opportunities. So if you work in a company whereby the financial, or let me say, the company does not sound good or well financially, it means that you should look for work elsewhere because tomorrow you may be fired because they may not have money to pay for your salary for you. Maybe they pay you every 3 months, every 6 months, every 2 months. It's a signal to you that, no, this business can survive for a longer time. So employees are interested about the financial stability of the business. Fringe benefit. What is fringe benefit? Yes. What is fringe benefit?
Allowances.
Yes, Francis.
Allowances.
Allowances. What kind of allowances are you talking about?
Let's say fuel and maintenance allowance.
Okay. Any other fringe benefit?
Health insurance benefits, housing
bonus.
benefits.
Hello? You said health insurance? Hello? You said health insurance and housing benefit, right? Okay. Any other fringe benefit?
Car allowance benefits.
Car loans.
Car loans, car allowance.
End of year
So let
policy.
so
March
okay. So
March
so so so
services.
all what you have said are examples of fringe benefits. So can somebody just put them together, and then so that those who don't understand about the word fringe benefit can understand it better. Okay. Can you just give us a scenario, a small scenario?
Like when you join a business or an
So,
organization,
Okay.
they have they have they have friend benefits like health, like my colleague said, like health. They take care of your kids, like the 3 kids, your wife
Okay.
or your
Okay.
husband. They go
Okay.
for the business organization take the cost
Okay.
of your health. Yeah. Or sometimes they give you fuel allowance and car maintenance
Okay.
allowance
Okay.
monthly, in addition to
Okay.
your salary. So how is it? So
Okay.
yeah. And sometimes
Okay.
as we are doing courses like this, some organization will pay for your fees.
Okay.
So these
Yes.
are some of the
Scholarships. Okay. Okay.
So it can be said that there are additional cash or non-cash benefits provided by an employer.
Excellent. Okay. Yeah. Okay. All right. Then the public too. Public need information about the trends and recent development. For example, you want to apply to GCTU, but nobody knows about GCTU. You're asking people around. Do you know about GCTU? They probably need to know. Oh, there's a public university. Oh, there's a public. Oh, it's a public university. Oh, yes. You need to know. Okay. You need to know. Okay. Now let's go to now that we have understood the uses of financial statement. Let's go to the procedure to interpret financial statement. Okay. Now we have three main ways to analyze financial statement. Either go by the trend analysis, or go by the common size analysis, or go by the ratio analysis. So these are the three ways you can analyze the financial statement. Either go by the trend analysis, or can go by the common size analysis, or can go by the ratio analysis. Let's take them one by one. Trend analysis. This involves comparing trends in a firm financials over a given number of years. For instance, you can compare a company's sales figure from 2007 to 2011 to see whether the sales are growing and whether the rate of growth is increasing, declining, or near constant. Let's look at the trend by computing the percentage change from one year to the other. Okay. This is the trend analysis. So we know a trend, right? We want to find about the pattern, whether it's increasing or decreasing. So let's say 2014, we are using sales. Okay. The sales 2014 is 100. They're using sales, that's the baseline, right? So in 2015, the sales increased by 110. 2016, it increased by 137.5%. It means the sales is increasing. Now, when you pick these three financial years, right? Okay, we know the sales, you find the sales from where? The income statement. So you are picking the income statement for 2014, 2015, and 2016. We are comparing sales, okay, the sales figures. And in 2014, okay, we use the 2014 as a base year, right? So we want to find out whether the sales is increasing or decreasing, and we have found that the sales is increasing from 2015 to 2016. Now the question we ask ourselves, why sales is increasing? So what goes into sales, right? So yeah, so this is similar to horizontal analysis. You know, in some books you find that they written horizontal analysis, vertical analysis, right? So the trend analysis talk about the horizontal analysis, horizontal. Okay, so all the figures in the first set of accounts, and okay, all right. So like it's similar. So the trend, some will say trend, some will say horizontal analysis. Okay, so this is what we are going to do. This is the work I'm going to give to you. Okay, you download the financial statement for maybe 5 years. Then you compare the variables in it, whether it's increasing or decreasing. if you are using the horizontal analysis or the trend analysis. And with the vertical analysis, you are not comparing years, but you are comparing the items within the same year. Okay? So this technique requires the figure in each financial statement, usually restricted to the statement of profit or loss account and the statement of financial position, to be expressed as a percent of the total amount. So this one, for example, in 2014, we take sales as the base year, right? And we compare cost of sales to sales, right? So, and then we compare the next one, the gross profits to sales, right? And then we compare the net profits to sales. So whatever items we pick or variable we pick within the financial statement that for that particular year, we compare to sales. That's what we mean by the vertical analysis. But with the horizontal analysis, we are comparing years, the variable from one year to the variables in the other year. These are the main difference. Okay. So we are going to do an example. So let's take an example of the EcoBank Limited income statement. That is 2007, 2008, 2009, and then 2010. Then 2010. So interest income. Okay. So interest income, we are comparing 2007, 2008. We've seen that there have been it's 41% increased, right? It's 41% increased. And then 2010, it has increased by the next year, that's 81%. Are we following?
Yes, sir.
Yes. Yes, sir.
Just for a minute, please. In a minute, in a jiffy, please.
Okay.
Okay, thank you. Okay, so can somebody tell us how we got about 41% change? Comparing 2007, 2008 interest income, we got 41%. Can somebody tell us how we got arrived at 41%?
So the difference between the income rates, the interest income from the 2008, you subtract the 2007 from the 2008. The difference you divide by the income you got in 2007, multiply by 100%. I think that's what got us the 41%.
Okay. So we did the same thing. I believe you understood. Please, I believe everybody got
Can
the
she come
concept.
again? Can she come? The network was bad. Can she come again?
Okay, your name, please. Who was talking? Sandra. Okay, so Sandra, please. They said come again. Okay.
So you subtract the interest from the 2007 from the 2008.
So Sandra, let's take it one by one. So I want to take it one by one. Let us all do it together right now. Okay. So let us all do it. So Sandra, go ahead and then take us through.
Okay, so the difference between the two income, which is the 2007 and the 2008, the answer you get, you divide by the 2007 interest income. You multiply by 100.
Sandra, maybe you didn't understand what I was trying to say. I said, let's take them once we got the concept once, everybody will able to do the rest. Okay. So let's take us through one by one. Let's go step by step. So you just indicate a figure and then go and then just solve it for us. For the
Okay.
first one.
So you subtract 51,779 from 72,754. And then
And you get what?
you get
20,000.
Yeah.
20,975.
Continue.
Yes. So that answer divided by 51,779 times 100%.
Okay. Okay. I believe everybody have got a concept.
So 40.50.
So, sir.
I believe everybody have got a concept, right?
Yes, sir. So, sir, please, can we say that figure is the increase amount?
Exactly.
The 20,000. Okay. Thank you, sir.
We are looking at the percentage. We are not using the 20. We are using the percentage to make our judgment or decision or to pass our comment. Right. Okay. The next one between 2008 and 2009. Yes, somebody should take us through. Hello. Please, can you hear me?
Yeah. Hello, sir.
So someone should take us through 2008 and 2009.
Okay. The same as what we did the first time. So this time we are comparing the figures in 2008 and 2009. So we are going to subtract the 72,754 from 131,379. And then we are going to get 50-something thousand. Then we divide by the 72,754. Then we multiply by 100.
Okay.
So we are going to get 80.574, but we run it up to 81%.
Okay. So we do the same thing to the rest. That's how can we got the percentage. Okay. This is the horizontal analysis. So you get the financial statement like this from the internet when you download it, right? And then you should do these calculations yourself, and then you write your comment. For example, the interest income, okay, between 2007 and 2008, okay, is 40% what? 41% increased. Then why it has increased by 41%? Right. So what goes into the interest income? When we say interest income, what does it mean? Interest income, can somebody tell us what interest income means? Yes.
Hello, sir.
Yes, please.
Please, they are the income that a company get from operating their businesses. It can be, examples are, let's say, the interest on giving out loans, the interest on clients opening their savings or current accounts.
Okay.
I think that is what I can say.
Okay. So you find the footnote under the financial statement that maybe they invested into this and they got so increasing interest income is coming from this kind of maybe investment they have done, right? Okay. So it will give you an insight to why the interest income is increasing. And then you in other cases too, you may find maybe the variable decreasing, and then why. Okay, now if the interest income is increasing, is it good for the company? Then write your opinion. Oh, it's good. If the interest income is increasing, good. Oh, it's not good. Then give your reasons. Okay, because you are analyzing the statement. Okay, so this is what you are going to do. Okay, but this is one way. You may choose either you want to do the trend analysis or the common size analysis or the ratio analysis. Okay, all right. So this is a summary of what we just did. This is a summary of what we just did. So this one, you see it clearly, the percentage increase or decrease, right? This, you see it clearly. Okay. Then let's go to the common side. That's the trend analysis. The common size. So the trend analysis or the horizontal analysis is what we have done. Then the common size. Okay. So this involves comparing each item in the financial statement to the total amount in the statement. Usually, income statement items are expressed as a percentage of sales, and the balance sheet items expressed as a percentage of total asset. Common size analysis is useful in comparing how various items in the financial statement relate to a key item in the statement. A key item. So, for example, you are comparing asset to maybe liabilities, or you are comparing maybe sales to maybe cost of sales, net profit, EBIT, earning before interest and tax, or tax or interest. So common size ratios are also very useful in comparing different companies in the same industry that operate at very different scales. Comparing figures of a very large company to that of a small company in the industry sometimes become difficult. So you can compare. So after you have done ratio analysis, you cannot compare the performance of a small business or compare to the performance of a big company. No. And then you cannot compare the performance of, let me say, or you cannot compare the performance of companies in different industries. When we say different industries, for example, you can compare the performance of GCTU to MTN because they are from different industries. You can compare the performance of GCTU to, let me say, GCB Bank. But you can compare the performance of GCB Bank to EcoBank. You can compare the performance of GCTU to Eugene, right? Because they are from the same industry. Okay. So this is an example of the vertical analysis. So we are using the same income statement for EcoBank. So the interest income, the same amount. So we are using the interest income as the base year, which is 100%, right? And we are comparing interest expense to interest income. We are comparing net interest income to interest income. We are comparing fee and commission income to interest income. So any other item we pick within the financial statement, we compare to the interest income because the interest income is the base year. We want to find out whether it is increasing or decreasing. And that is what we mean by the vertical analysis or common size analysis. Somebody will say common size analysis. Somebody will say vertical analysis. Somebody will say trend analysis. Somebody will say horizontal analysis. They mean the same thing. I believe you all got this concept. Okay. Here's the summary. Okay. Now let's come to the ratio analysis. For ratios are full of formulas. Ratios are full of formulas. You don't need to chew and pour the formulas in your head because if you are given a question to analyze the financial performance of the business, the formulas will be given to you. You give a formula book. They look for the formula, the very formulas you need. Then you apply them accordingly. But in your case, you don't have any exams, you don't write any exams, or I will not assess you under this particular topic in the examination hall, but I'm going to assess you for your assignment. So the assignment will cover only this. So you have all the formulas with you. You apply them accordingly. I'm going to ask you to go to the website, download a name. I'll give you the name of the company. Go to the company's site, download the financial statement for 5 years, and then analyze the performance of the business, and then write your comment. So you may choose whichever analysis tools you want to use. Either you could use the trend analysis or the common size analysis or the ratio analysis. It's up to you. So financial ratios are full of formulas. Let's go straight to. So we have 5 groups of ratios that we can group them, or we can categorize ratio analysis into 5 groups. We have liquidity or solvency ratios. We have profitability ratios. We have efficiency ratios. We have investment ratios. They have gearing or leverage ratios. These are 5 broad categories of ratio analysis. Now let's take them one by one. So with liquidity or solvency ratio, this helps out to measure the extent to which an entity is able to settle its current liabilities and remain solvent. In other words, they try to assess how much cash the entity has available in the short term, that within a year, that 12 months. And if assets can be turned into cash quickly in order to settle current liabilities. So liquidity ratios, we want to find out that can the business be able to pay its short-term debt, or can the business able to convert its asset into cash so that the business can pay debt within a year. That is all. If you want to assess about, we want to measure the liquidity of the business. We are talking about the business have cash, liquid money to be able to pay for debt within a year. Now, with the profitability ratios, it measures the extent to which an entity has been able to generate an adequate return in relation to the resources it had. So, if you want to measure the extent to which the business have been able to generate adequate return, that is able to make money, utilize the resources in the business to generate income, right? That you go to profitability ratios. Then we have the efficiency ratios. It tells us how an entity or how the business have been able to manage, how well its resources have been looked after by those running the businesses. Okay. Then you have the investor ratios relate to the market value of company shares and dividends and are of interest to investors in listed companies primarily. You have the general leverage ratios, provide information about the funding structure of a business and measure the extent to which an entity is able to settle its non-current obligations. Example, repay its debt funders. Okay, so the capital structure, if you want to find out about the capital structure of the business, we use the gearing or leverage ratios. And then we know we have the debt, we have the, the debt, you're talking about bonds, right? Okay. So the capital structure of the company may be made up of retained earnings, then equity, and then debt. Some are 100% shares, some are 100% equity, some are 100% retained earnings, some are 100%. It depends upon the policy of the company. Okay, let's take them one by one. So under the liquidity ratios, we have different type of ratio that comes under liquidity ratios. We have current ratio. We have current ratio. And the formula is current asset divided by current liabilities. You find the assets are found from where? You can find the asset from where? The balance sheet. You find the liabilities from where? The balance sheet. So you just lift the information from the balance sheet and then you put it there to give you the result for the current ratio. We also have another formula under the liquidity ratio called quick ratio or asset ratio test. Quick ratio or asset ratio test. So that is the current asset minus inventories divided by current liabilities. If we want to find out, if we want to know the rare money, the rare liquid money, right? Because with the current ratio, with the current asset, inventories are part of the current asset. And inventory, we are not going to convert the inventory into cash. Okay. But if you want to see the quick ratio, that is the money you have in the liquid money, then you take off your inventories to find out about the real money you have. That will you be able to use that money to pay for your short-term debt? That is you want to look at the quick ratio. You have what's called the cash ratio. The cash ratio is called the cash divided by current liabilities. The cash, and then when we talk about cash, we talk about cash in hand, cash at bank, cash in your Momo. They are all cash, right? Divided by your current liabilities. You can use any of this to assess the performance of the business. That's the liquidity ratio. Then we can also look at debt collection period. Okay, so when you collect money from debtors, you collect money from your debtors, right? The money is coming to you get your cash, right? So if you know that, within 2 days, you're going to collect this money, it means the money is yours. It means the liquid money, you have a liquid money to pay for debt, short-term debt. So the formula is average trade receivables. If you have given your debtors 365 days, right? If it is in days, use 365 days. If you're giving them in months, use 12 months, right? If you are giving them in years, you have months and you have days, right? Okay. So is 3 5 days make a year, you know that. And then 12 months make a year, 12 months. If it's in weeks, it's 52 weeks. You apply 52 weeks, right? So either in weeks, either in days, either in weeks, or either in months. Okay, apply that accordingly. Then creditor payment period. So average trade payables, and then you apply if it's in days, 3 to 5 days. If it's in weeks, 52 weeks. If it is in months, 12 months. Divided by your credit pages. Okay. Let's take an example. Let's compare this. I want someone to analyze this performance of these two companies, Capwell Cola and then Spresley Spritzers, using the current ratio, the quick ratio or asset ratio test, and the cash ratio for us. The floor is open.
Hello, sir.
Yes, please. Please go ahead.
Please, mine is a question before the asset test ratio, the formula over there, the inventory. Is it a closing inventory, closing stock, or opening? I want to know what constitutes the inventories.
What is closing stock? What is opening stock? You see, some of us do not understand this kind of terms. So, what is closing stock and what is opening stock? Before we come to your question, please tell us.
Okay, to my understanding, when you talk about So my understand when you talk about the opening stock, they are the goods that you use to start the business at the beginning of the year. And the closing stock will be the one that's at the end of the year, that the goods that remain in our shop. That will be the closing.
Example.
Example, like I have stationery. At the beginning, I have a stationery of 15,000. And at the close, I have a stationery of, let's say, 3,000.
Okay. So some people will still not get the concept of closing stock and opening stock. Can somebody give it, or can you give a different example? Let's use a laptop. Let me say a mobile phone laptop. Okay, use that one.
Okay. Okay, sir. At the beginning of my business, beginning of the year 2026, I have a laptop of 60,000 in my shop.
So when you are starting the business, right?
Yes, sir.
You have
Yes,
your
sir.
shop. You have your shop in Circle, and then
Yes, sir.
you bought laptops of
Yes,
60
sir.
pieces, 60 pieces of laptops, right? Quantities
Piece of
or pieces
laptop.
of
Yes,
laptop.
sir. Piece of
And then
laptops.
yes,
And
okay.
at the end of the year, which is as at 31st December.
And then you sold this is CC laptop. You sold some. You bought additional one. You sold some. You bought additional one. So at the end of the year,
At the end of the year, I have remaining 20
okay,
laptops remaining in the shop.
Okay.
So that one become the remaining one become the closing stock.
So the 20 becomes your closing stock.
Yes, sir.
And the 60 becomes your
opening stock.
Okay. So I think everybody will understand this. Okay. Now let's go back to the question. The person asked a question. The inventory. He said inventory. Yes. Who is talking? Is this Sandra?
Yes.
Sandra?
So this
Is it
is
Sandra?
Joyce. Please, we
Joyce.
have 30 minutes break.
Okay. Okay, then let me break you guys and then we come back. Okay? All right. Thank you.
Hello.
And then I said, let me break you and you come back for 30 minutes. Okay?
All right. Thank you.
Okay. You are welcome. All right. Hello. So let's have a break of 30 minutes according to the timetable. Then we come back after 30 minutes to continue.
Okay. Thank you.
Hello. I think we are back from break.
Okay, it's 30 minutes, so 7 minutes more.
7 minutes more, okay.
Yes, sir.
So we should wait, okay.
Yes,
All right.
please.
Hello.
I know.
Okay, so let's continue from where we ended, and then I'll leave the rest with you to go through. So somebody should take us through this. The current ratio. So we are comparing two companies. We have Cobweb Cola, especially Spritzers. So the current ratio of 1.0596. What does it mean for Cobweb Cola? And that of 1.0286. What does it mean? And which of them is doing better than the other? Yes, the floor is open.
Hello, sir.
Yes, you can go ahead. Anyone? Yes.
Okay. My name is Anthony.
Mm-hmm.
With the first one, what I would say is that the company current assets, the company has more current assets to settle its current liabilities within that year. So against the other one, the Spacely Sprinters, the Sprinters,
Mm-hmm.
I would say the first one is better than the second one because they
Why?
were able to have more current asset against the its current liability.
Okay. What about the quick ratio acid of 0.8379 for Cobweb Cola, and then that of especially Spritzers 0.5465?
With that one too, I would say that they are better as compared to the second one because looking at the formula, the acid test ratio, that is a current assets minus inventory over current liability. So basically, the company has more current assets to settle its current liability, deducting inventory from it against the second company. So with the first one, it's performing well than the second one.
Any other
Thank you.
explanation? Yeah, let's hear from others. Let's hear from others. Others. Yeah, he has given a very good point, good explanations. What about you? What are you saying about the quick ratio of 0.8379 of Cobweb Cola to that of Spacely Spritzers of 0.5465?
Sir,
Yes, please go ahead.
sir, this is Sandra. The second one, the quick ratio, it means that the cow's well cooler has assets they can quickly turn into cash to pay their short-term loans better than the Spacely prices.
Sandra?
Yes, sir. Yes, sir.
Yeah, please come again.
So I'm saying that the quick ratio of the cow's well cooler is higher than that of the Spacely prizes because they are able to, they have assets they can turn into quick cash to be able to like pay their short-term loans better than that of the other company.
Okay. What about cash ratio of 0.2707 for Cabware Cola, and that of Specially Spirited 0.214.
Okay. So for the first one, I would say that the company was able to pay its current service by using most of its liquid asset to pay, as compared to the other one, which is the first one is 0.27 and the other one is 0.21. So the first one was able to manage its liquid asset to pay the its loan, its short-term loan. Thank you.
All right, thank you. So we have the solvency ratio, we have debt ratio, which is total asset minus total equity divided by total asset, or total liabilities divided by total asset. Okay, then you have the time interest earned, the earning before interest and tax divided, that's EBIT, divided by interest expense. Okay. Or we have the formula that is a cash coverage ratio to earning before interest and tax plus depreciation divided by interest expense. Okay, all these are formulas. So you just leave them from the financial statement. So let's compare this. Cover the same two companies using the debt ratio, time interest. So the first one, the debt ratio of 0.6042 for Capwell Cola, and the debt ratio of 0.6398 for Spresley Splitter. What does it mean? And who is performing better than the other?
But can you come again with the question, please?
I said, explain to add the debt ratio of 0.6042 for Cabwell Cola, and that was Spresley Splitter 0.6398. What does it mean? What does this debt ratio means? And then who is performing better than the other? Comparing.
Okay, sir. Concern the debt ratio, which means that the first, comparing the A and B, which means that A is performing more better than B. Why? Because A is using more, the debt ratio in the debt capital in A is lower than as compared to the one of the B. Thank you, sir.
Let's hear from others, please. Okay, continue, please. Come, you can come. Please go ahead.
No, it means to me, it means Carlos Cola has less debt. They don't have much debt as compared to the Spicely. So therefore, the
Hello, your line was breaking. Your line is breaking. Sorry, line is breaking. Your line is breaking.
Hello, sir.
Yes, please.
Okay, I would like to come in. Looking at the ratio, it means that both companies are highly geared, which makes them debt riskier.
Okay.
But Coxwell having a ratio of 0.06042 makes it highly riskier than that of Spacely Spritzes. Splitter is slightly riskier since it depends more on debt financing than Coxwell.
Okay, so let me add this to what you guys are saying. Okay, so the ratio, debt ratio of 0.6042 means that the Coca-Cola has is finance the business using debt of 60%, 60.42%. And that especially is financing the business activities with debt financing of 63.98%. So the especially is more riskier than the Cowell, even though both is risky to finance the total capital sort of 60.42%. Okay, it's not the best, but especially splitters is more riskier than that of the Cowell Cola. Okay, now let's move to the times interest end. Times interest end of 28.3483 for Cowell Cola and that of 6.8879 of specific splitters. What does it mean, please?
Okay, so this is Derek.
Okay.
So with the times interest earning, it is more like the operating earnings that both companies can cover up for their interest expense. So looking at the Cowell's Cooler, it has a 28.3 times let's say leverage to cover interest expense as compared to the 0.88 times spacely splitters have. So it means that Cowell Cola is doing much better more than the splitters.
Okay. What about cash ratio coverage of 34.9, 34.5955 for Cowell Cola and that of 9.7757 for specially splitters? What does it mean?
So it's basically the same as interest cover in terms of cash. So Cowell has a 34% leverage when it comes to operating cash as compared to the 9.7 leverage Spacely has.
Okay. Okay. So on that note, I want us to end our lecture on financial statement and analyzing financial statement here. I'm going to give you an assignment. So with assignment, you have the option to choose either trend analysis or common size analysis or the ratio analysis to analyze the performance of the business and pass your comment. So I'll share the question with your class rep and then she will share with you. You should submit your assignment within 3 weeks' time. Within 2 weeks' time, sorry. 2 weeks' time. So by 2 weeks' time, your assignment should be submitted. I'll check if the platform is working, then I'll ask you to submit it. If not, you submit to my mail. So I'll let you know before our next lecture next week. Okay.
So please, the LMS, we've been enrolled on the LMS, so.
LMS, okay, good. So I'll upload it on the LMS. If you have access to LMS, then that is excellent. So that you just get your assignment from the LMS and then submit it to the LMS. Okay. Then that is perfect. So I'll do that. Okay. Any question before I end my lecture?
Yes, sir.
Sir, please. This is Bismarck.
Okay, Bismarck, go ahead.
Sir, please, what's the difference between income and revenue?
Income and revenue. Okay, somebody's asking difference between income and revenue. Please, the floor is open. Someone should answer him. Income and revenue. Someone want to find out what the difference. Is there a difference? income and revenue. Yeah, Sandra.
Yeah, this is okay. For revenue, I think revenue is the total amount of money earned from a sale or services that a company is provided. And I think income is the expenses, the profits that are remain after deducting the expenses from the revenue.
Okay. Please, are you okay with the answers? The one who asked the question, please, are you okay with the answers?
Oh, he's gone.
Any other question, please, before I end my lecture?
Yes, please. Doc, this is Gilbert.
Gilbert, okay.
Looking at the ratios, in, let's say, computing for the current ratio, the formula being current assets over current liabilities. There are some, let's say, financial reports. When you take a GCB bank, for instance, when you go to the statement of financial position, the underlying items there sometimes is make it difficult for you to able to differentiate the current, let's say, assets. Like they'll give you property, equipment, and let's say leaseholds. Then when you go to the footnote, they have other underlying, let's say, items like other assets. But the footnote does not give you a detailed information as to the other assets, which of them are non-current and which of them are, let's say, current. So in a situation like this, how will you able to come out with the best figure to determine your current assets?
In brief, come again with your question so that your colleagues will understand you. Can understand, sorry.
Okay. As some institutions, when, let's say, they are classified in the financial statement of financial position, the asset side, the line items under the assets, you see cash and cash equivalents, non-pledged trading assets like investment and other securities, loans and advances. We know all these are current assets. Then they come to the non-current assets. They state property, plant, and equipment. But before the non-current assets, you see other assets stated there. But the other assets are not specified in the footnote for you to know that maybe if there are other underlying items that falls under current or, let's say, non-current. So I'm asking, when one is faced with this issue, how will you go about it?
The floor is open, please, to everyone. Hello, we don't have accountants, some accountants. Yes, the floor is open. Did you really understand the question, first of all? Secondly, what is your take in this, please? What's your name? The person who asked the question, what is your name?
Gilbert, please.
Gilbert. So you mean the statement didn't say anything about
assets.
Current asset?
Yeah, I mean, yes, under the current assets.
So cash and equivalent you mentioned, is it not a current asset?
Yes, they are there. Loans and advances.
Mm-hmm.
Advances to banks.
Mm-hmm.
Yes.
So can't you use that one?
But they have another underlying item, say other assets before the non-current, what do you call it?
So the other assets falls under the current asset, right?
Yes, please.
Yeah, it means it is a current asset. It's a current asset. So it should be considered as a current. Once it has been considered under the statement as a current other asset, as a current asset, it should be considered. Meaning they don't want to mention them one by one.
Okay. Okay.
So you can use that and apply the formula.
All right. Thank you so much.
You're welcome. All right, so I'll leave you guys, please. I'll give you work. You have your time to go through. Then try to solve. I've given a question in the slides. You try to solve the questions. Use the formulas. Okay, compute them, and so I become familiar to the formulas. And then please take your time to solve your question and present and send it to me. You type them. Okay. But remember, I said I'm not going to assess you in the exams on this particular topic. Okay.
Hello,
All right.
sir.
Yes. Who is speaking?
It's Joyce.
Okay, Joyce. Yes. Mm-hmm.
Yes, sir, you made mention that we'll discuss the time when we meet today.
Joyce, where is your face? Let's see your face. Joyce, are you there? We don't know Joyce talking. Last week I showed my face, right? You saw me. So we don't know the one talking. Joyce, we don't know even the class rep, Joyce. Joyce, can we see you? Is it possible? We can see you.
Hello, sir.
Wow.
Hey, who is say wow, wow?
I say wow.
Joyce, we are not able to see you.
Really?
Okay.
That
Pick
you
my
are
video.
one.
You come on and off.
Oh, okay. It's the network.
Dog, it's your network. The beauty is destroying your network.
Hey. I see. That's why I say wow, wow. I see. Okay. So Joyce is enough. We've seen your face. No. They want to see your face. Your members want to see your face. They've not seen it before. So show your face well so that they want to see their class rep face. Mm-hmm. Joyce, are you there? You come on off. Are you there?
Yes, sir.
Okay. This is your class rep. So when you meet her, you should be able to identify her. Okay. Thank you very much for the understanding. Okay, Joyce.
Okay.
So you can put your video off. Thank you. Okay. Okay, so Joyce is asking. So Joyce, what are you proposing? What time are you proposing?
Yes, sir. You made mention the last time we complained that the convenient for us. It's not convenient, so we would like you to kindly consider the time for us.
Joyce, what do you mean by convenience? I don't understand convenience you are talking about here.
So most of us complain that we'll be in church by then. Some of us have some rules in our various churches, and due to that, some of us are not able to concentrate throughout the period of the lecture, and some of us are not able to also contribute. Hello.
So Joyce, what is your proposal?
We would like you to kindly shift the class to afternoon, hopefully from 1.
On 1.
Yes,
Your
sir.
lecture is it weekdays or weekend?
It's weekend, sir.
So weekends Between weekends, what are the weekend days?
That's Saturday and Sunday.
That's
But most of the week,
Friday,
no,
Saturday,
Saturday and
Sunday. Okay, so if we don't do it early, do you think we can have time to meet at afternoon time?
yes, most of our Sunday classes were in the afternoon.
So your Sunday lectures are in the afternoon.
Yes, sir.
From what time to what time?
From 2 to 6. Some
2 to
are
6.
5.
2 to 6. You have a class.
You have
I
a
have
class. Oh,
I have a class at that is 4 o'clock. So we can do it let me say 11. Will 11 be okay? Yeah, 11 will not be bad.
yes, sir. 11 is okay.
Yeah. Or if everybody will agree, please. Yeah, let's discuss the class. The time, okay? 8 a.m. or 11 a.m.
Doc, 11 is okay.
Okay. Okay.
8-2 is okay.
8-2 is okay.
Some people prefer 8.
Please, 8 is okay.
Oh.
Yeah, I like the 8.
And from there, we can go to church.
Okay, 8 is okay.
After the lectures is not forever. Church is forever. So 8 is fine.
Yeah,
It is okay.
You can also go for second service after 8 when we have our lecture. We finish.
Yes.
We can finish early.
Second service.
Oh,
Dog, if you can do maybe 8 to 10, then after 10 we will go to the second service.
excellent. That is fine.
Yes, I think I also like.
We can do 8 to 10. Then we go. Yeah.
That
Yes.
is if it will be okay for you to cover whatever we need to cover within the
It
week.
means that we know that we are within 2 hours. We should be finishing. Yeah. We'll be
And
able to
so
cover.
looking at your
And then we'll be able to cover because
lecture,
we are going to have one face to face. So the one we are able to cover when we meet the face to face, we finish everything. So we'll be able to cover. We can. I think we can manage it.
don't pile up for one face because after the face to face, you only have 1 week for revision before the exam.
Yeah. I'll not pile up. I don't think we pile up. So
it's just for I think 5-6 weeks. Just sacrifice and then get this done, and then from there we can continue with our church activities.
okay. Thank you. So thank you for your understanding. So Joyce.
Yes, sir. Yes, sir.
So let's manage the 8. Okay.
Yes, sir. Okay, sir.
Thank you so much for the understanding. Okay. All right. So let me leave you. Some of you will be going to church, while some of you will be doing your church service online from the house. Okay. And some of you will be going to the pub to have fun. Some of you will be going to the beach sides with your side chicks, with your girlfriends, with your wives, with your family. Some of you will be going for marriage. Some of you will be going for funeral. Some of you will be going for birthday. You said?
Some to be chopping fufu.
Hello.
You are spoiling some of us.
It's part of life, it's part of life. Having fun is part of life. It's very important, you know that.
Some
And
of us
then it's
don't
only
mind.
weekends that you can have fun. So you should have fun to the fullest. Okay.
Very have fun. Very have.
We are going to prepare weekend fufu for our family.
Yes, some of you be preparing food for the family, and then when you finish, you have a good time. You can just take a stroll, okay, in town, and then it's very important. It's very important. You see. Yeah, very important. Okay. So when you eat, after eating, then you eat well. You know that?
Okay.
After you finish eating, after eating the food, then you eat well. You eat well too. Okay?
That one is very necessary.
Let's go to the bachelors.
Yeah. Or the bachelors too. They have the bachelors too. You should. I believe they have girlfriends. There's nothing wrong with you having a girlfriend.
I don't mind it.
Guys, you're mature. Okay.
Okay, yeah, guy, Ralph.
Yeah, and then our ladies should look palatable, choppable. Okay, so that delicious. So that after eating, yeah, if
We are going too far.
Remember the Sabbath day and keep it holy.
Exactly. You wear the hot the hot dresses, and then very important, so that we see that no, we have everything in the house, so that we'll not be going out, we'll not be
Full
going
package
outside the
in the
house.
house. We understand.
You don't put on from head to toe that we don't see anything. Then when you go outside, we see something different. Then we say, "Oh, but you have everything." Yeah, you have everything. So please, do it for us, okay? So that we can stay at home with you. Okay. All right. So let's draw the curtain. Okay. We meet next week. Enjoy, please. Have fun. Life is short. Let me tell you. At the end of all this thing in life, work, the money you are making, the fight, the grudges, is what? Death. You die. You leave all this thing on this earth. You leave all this on this earth. So one thing to understand.
Enjoy life. Why?
Enjoy life to the fullest. Have fun. Don't let anything worry you. Troubles will come and go away. Okay? So
Don't
enjoy
let
life.
it worries you.
Never.
You don't make death.
And never. And so please enjoy life. Our ladies, make our men happy. Our men, make our ladies happy. Okay? That's the most important thing we need to do whilst we are on this earth. That is all.
Yeah.
All right. See you.
Enjoy your Sunday.
Nice weekend.
So you said it all. God bless you. That's what we want to hear.
Amen. You too. You too. Enjoy. Enjoy.
Side chicks.
Enjoy. Enjoy the married ones to enjoy also with the side checks. Very important, Charlie. Very important. Very important. You know, men. That is our gen. God. That's how God created us. So.
That one, no. That you have deleted that one from the speech.
No.
that one has actually been recorded double.
You guys said you are going to church or church second service.
But we are doing second service here. This is second service.
Preach on.
Exactly. No, see what I'm saying is true. Please don't let anything worries you. Please, your health is very, very important. Okay. And do exercise, do gym. You can go for gym, go for walk, and then check your food, your diet. The kind of food you eat to your system is very, very important. Okay.
Offering time.
Blessing time.
All right. See you next week. Take care. Bye-bye.
Bye.
Hello, Joyce. Joyce. Papa Sam.
Yes.
Please, 4 p.m. no how far? Financial regulation.
We are still in contact with him, so let's all join by 4.
Please contact him so that we will be sure. Okay, we beg.
No, the issue even with we need to talk to the school to give us a link.
We'll be on standby.
Okay, all right.
Please, it's the same link. Why?
For there will be you. When I know if Inframano.
And the same link. Yeah.
It's the same link. The IT guy will use the same link, so just use the same link.
So Joyce, please contact him so that we'll be sure.
He said he will meet us, so you don't worry. If anything, or friend me Pemeka Cho. He said he will be.
We'll meet him. We'll prepare for him.
Okay.
Okay,
Put this
okay.
one ended so that at least you can make time and meet him at 4.